Last week, we talked about when a boring asset class like whole life insurance can outperform your 401k. This week, we're busting myths. We're going to talk about what actually happens to your cash value of your life insurance when you die. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
All right, I know we hear this from Dave Ramsey, but there's a lot of critics of whole life insurance and permanent life insurance in general that love to say the insurance company is just going to keep your money when you die. You only get the death benefit. What do you say to that, Carlo?
Well, the reality is that the cash value is really just a subset of your death benefit. And you do have a contractual obligation where the insurance company has a contractual obligation to allow you access to that cash value. But really, that's the premiums paid in, and the cash value is part of that death benefit, and it's that the death benefit represents the future value of that cash value.
Okay, let's break this down between whole life and IUL, because those are the main types of cash value life insurance that we deal with. In a whole life policy, you have a guaranteed growth rate. And the way that that cash value is determined is the money that you send in as premiums. The insurance company has to make the cash value equal the death benefit at maturity, which is like age 105 or age 121. There's different products, or there could even be different rules depending on when you purchase the product. But that guarantee has to get to that death benefit. When you give the insurance company money, it's not yours anymore. So when Dave says they keep your money, it's not your money. The minute you pay that premium, you gave that money to the insurance company. And that cash value that it turns into is the current value of the future death benefit. At the guaranteed growth rate, that cash value will equal that death benefit. And then they have that money to pay out to you, guaranteed. It just so happens in whole life, a lot of the ones that we like to do, you're going to get dividends that are excess, above and beyond the guarantees. And those are going to buy more death benefit on top of that if you're buying paid up additions with that excess cash.
Yeah, and actually kind of connected to that on the whole life side, when you're buying paid up additions, if you have a type of policy that represents those paid up additions as an increasing your death benefit versus decreasing the net amount at risk, it's sort of a technical thing. But if you have one that does that, well, one of the things that you can watch happen as you age over time is your paid up additions actually end up reflecting less death benefit as you get older, because that future value is diminishing because you don't have as much growth time involved there. So that multiplier of cash value of those paid up additions to the death benefit is a way to see it once you have a policy or see some of these things in force.
That's an excellent point. I like to look at it as the cost of insurance going up as you get older as well. But you're right, the guarantees, that cash value has to equal the death benefit. And so it's only natural. If you have less years for those dollars to compound at the guaranteed rate, it's going to equal less death benefit.
Yep, exactly. And I think it's really, to me, one of those clear examples of how that is representative of that future value of the cash value. And in your whole life, your base policy, you'll start to see that cash value grow over time as part of that. And eventually, like James said, that will equal the base death benefit that you had purchased in that policy.
Now, I know the reason I was thinking about it as the expense is because I deal with a lot of IUL. And in IUL, we're dealing with annual renewable term insurance. And the cost of that insurance goes up a little bit every year you get older. And there is no paid up additions. You just have your cash value, and then you have the expense in the policy. And the cash value, again, not your money. You gave your money to the insurance company, and they gave you an obligation, a death benefit, and access to a certain amount of that death benefit, which is declared as cash value or surrender value, they call it. If you want to cancel your policy, you get a certain amount of your money back. But while you have the policy, it's not your money.
Yeah, and in an IUL, if you fund an IUL high enough and reduce your death benefit to the minimums, you could potentially, there's no such thing as on the whole life side of reduced paid up, but those expenses would just get subtracted from the cash value that you have inside of that policy. And it could potentially last the rest of your life if you funded it high enough and you don't really want to fund it anymore. That is one way to kind of turn off the premiums in an IUL.
So we see the cash value, the surrender value growing in whole life and in IUL. We can see it growing year after year. Sometimes the death benefit might be growing, sometimes it might not. But what is the difference between the cash value and the overall death benefit in an IUL? Because we already talked about whole life. What is that in the IUL?
Well, that would be the net amount at risk. And what that represents is effectually what your cost of insurance is calculated based on. And so in an IUL, when your cash value grows and gets closer to the total death benefit, it really can make the costs relatively low by decreasing that net amount at risk.
Yeah, in an IUL, it's a flexible premium policy, but you can choose whether to have an increasing death benefit or a level death benefit or a mix of the two. There's different names for the other kind, return of premium, things like that. But essentially, you have different options to decide how much net amount at risk do you want to pay for throughout the life of that policy. So you get to decide what the expenses are going to be. When that death benefit pays out, it's going to pay out whatever the cash value has grown up to be, plus the net amount at risk above and beyond that. So in the case of the IUL, it's definitely not accurate to say that the insurance company keeps your money and you only get the death benefit, because that overall death benefit pays out the cash value plus the amount that you told the insurance company, I want to pay for this much extra on top of that cash value. The nice thing is that all of it goes tax-free to your beneficiaries, and they just lump it into the death benefit.
Yeah, and it tends to be easier to see when you're using that increasing death benefit. You can kind of see, hey, here's my cash value, and here's the total. And when you just add it up, the amount of life insurance you're paying for is very easy to see when you can easily subtract that, and you just get your cash value or your accumulation value, depending on what the carrier is. They'll have different names for that.
Yeah, just check the policy charges ledger, which is only available in the IUL. It's not available in whole life, but a policy charges ledger shows you what the cost of insurance is. And when you look at a design that has changed from an increasing death benefit to a level death benefit and reduced it to the guideline minimum, that tells the insurance company, hey, every year moving forward, I just want to pay for the minimum amount of insurance that I'm required to, based on how much cash value I have in this policy. And if you look at that illustration, you can see how much death benefit you're paying for each year and how the cost reflects that. Because as you get older, the multiplier that you have, the amount of death benefit you have to pay for above and beyond that cash value goes down a little bit each year. So even though the cost of insurance, of annual renewable term insurance, goes up each year, we can see our costs inside of it going down if we're paying for the minimum amount that's required.
Yeah, and I think that's what can cause, so a lot of people will tend to say that the IULs late years can get very expensive insurance. But the reality is, because you can reduce that guideline minimum, the relative amount of insurance can be very, very small. You can have a tiny amount of insurance in comparison to your total cash value. And that's the goal with these things, is to have high cash value when you're in your later years, and a small net amount at risk, because that way you can have the total costs in that policy be less than 1%, a fraction of a percent, in respect to the cash value that's in that policy.
Generally, the clients that I'm working with IUL, our focus is to grow that cash. The reason we're choosing the IUL is because of that really low cost of insurance upfront, the greater growth potential, but then the ability to reduce those expenses quite a bit in older age. In the case of whole life, you can't see what the expenses are that they're charging you. But early on in the policy, the insurance company is charging you more than they need to because they need to set aside money so that they can cover that increasing cost of insurance, because they're going to either hold that death benefit the same or increase it throughout the life of your policy. And for them to be able to do that, they have to have more money in reserves, certainly so that they can meet those guarantees. But they also need to make sure that they have enough to cover those expenses. All right, I think we can call this myth busted. The cash value is a part of the overall death benefit that gets paid out, and the expenses in a policy are determined based on the net amount at risk. It doesn't matter what type of life insurance you're buying, that's how everything gets calculated. And so for anybody to claim that the cash value, the insurance company keeps it, is just wrong, or they're trying to manipulate you for some odd reason. Be careful if you hear people say that, or I should say be skeptical if you hear that claim. Be sure to join us next week where we cover what does the dividend rate actually mean. With that, I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. We'll see you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.